You want me to invest? Very risky, right? Very risky. Later I lose all my money, how? Perhaps you may feel this way. Yet, you know that if you do not invest, you may not have the chance to retire early. In this video, I'm going to share with you 5 ways on how you can reduce your investment risk. The first way to manage your risk is to avoid the risk completely. Yes, that means don't even invest at all. But if you don't invest and take the safest option of stashing all your money under the mattress, would you still face any risk? Yes, you definitely still face risk. Perhaps your house may get burned down, or perhaps a burglar might break into your house and rob your money. Then maybe you'll say, "Aiya, like that, I just leave in the bank lah." What if you stash all your money in the bank account and the bank closes? Like what happened to Lehman Brothers, one of the biggest banks in the world? Even if absolutely nothing happens to your money in the bank, do you know that you're losing every single year due to inflation? Inflation is basically the rise in prices of your goods and services. Take for example your chicken rice. In 10 years ago, I remember a plate of chicken rice only cost $2. Now 10 years later, it costs how much? At least $4. The average inflation rate per year in Singapore is about 3% since 1962. So if your bank gives you 1% interest, you are still losing 2% every single year. So you see, no matter which option you take, there's always risk involved, even if it seems like the safest option. That's why avoiding risk completely may not be the best solution for you. That's why the next strategy of risk management comes in. The second way to manage your risk is to accept the risk. Understand and accept that no matter which decision you take, there will always be risk involved. For example, if you want to invest in a US stock, what are the risks that you will face before you invest in the stock? For example, if you want to invest in a stock in the US, ask yourself what kind of risk will you have to take first before you invest in the stock. For example, one risk that I can think of is currency risk. That means the change of value when you convert from your Singapore dollar to US dollar before you invest. And the second risk I can think of is taxation risk. Some foreign countries will tax you based on the dividends and capital gains when you invest. So these are the kinds of risks that are involved before you invest in foreign stocks. Okay, so the idea is to list down the list of risks before you invest. Because by listing down all these risks, you have a better idea on how to deal with all these risks. For example, one way to deal with the currency risk and taxation risk is to simply invest in local stocks. The third way to handle risk is to mitigate the risk, which is probably the most common risk management technique. Mitigation just means reducing the impact of the risk if it does happen. So what you can do is, for example, the first one is to educate yourself. Equip yourself with the relevant knowledge, expertise, and experience so that you can protect yourself from investment risk. Equip yourself with knowledge, expertise, and experience by investing in online courses, books, or even mentors. And that's what I did before I started investing in stocks. I invested in myself first. I paid for books, courses, online courses, investing courses, seminars, coaches. I even pursued my degree in econs and finance. So it's like taking a driving license. You cannot completely avoid the risk completely, but you can mitigate the risk by learning and passing the theory test, the practical test. Another way to mitigate the risk is through diversification. Because nobody can predict with 100% accuracy when the market is going to go up and when the market is going to go down. That's why it's so important to diversify your money across different sectors, countries, and even asset classes. That way, you have a lesser chance of you losing your money. The third way you can reduce your risk is through investing for the long term. Many studies have shown that if you invest for the long term, you have a lesser risk of you losing your money and higher returns due to compounding interest. Take for example the S&P 500, which is the top 500 US stocks. If you invested since 90 years ago, you would have made 9.8% every single year with zero risk of loss. The fourth way is to exploit the risk. Who says investment risk is a bad thing? What if you can exploit it and profit from it? As Warren Buffett, one of the most successful investors in the world, once said, "Be fearful when others are greedy and be greedy when others are fearful." The first way is to buy when others are selling, because when the prices are down, it is the best time to buy great businesses at a discount. The second way is dollar cost averaging. This is great if you don't have the time to go and monitor your stocks, you know when to buy and when to sell. Dollar cost averaging allows you to buy units at regular periods of time at different prices. So whether the market is up or down, you are investing monthly. For example, you're investing $100 monthly. The last way is to transfer out risk, which is something that many investors overlook. And one way to transfer risk is through insurance. As a financial advisor, I've seen many people having to sell off their assets, their investments, just to pay off the medical bills, or because they don't have adequate insurance. And this doesn't only apply to yourself, but also applies to your family as well. I know a client, one of my clients, he had to sell away all his investments all because his mom doesn't have adequate insurance. So he has to sell all his investments just to pay for the medical bills. But assuming you have little to no knowledge, experience, or time to go and monitor and manage your investments, you can hire an investment professional to manage for you. And you can do this through investing in mutual funds, index funds, ETFs, or even through financial advisors. Okay, so by doing that, you are leveraging on other people's time, money, expertise, knowledge. In summary, these are the 5 ways to manage your investment risk. If you like this video and want to see more videos like this, remember to click the like button, subscribe, hit the notification bell, and I'll see you soon in the next video. Bye bye!